After a quick-fire trio of interest rate decisions this month from the Bank of Japan, US Federal Reserve and our very own Bank of England, attention can now return to company matters. Walmart's latest quarterly results on Thursday the 15th will attract attention, as it's a great barometer for both the US consumer and how American companies may look to manage supply chains and pricing in the light of President Trump's tariffs. Well, we've also got a busy slate of corporate statements on this side of the Atlantic to which we can look forward. Names which may be worthy of note include the following: DCC, Renew, Treat and On the Beach on Tuesday the 13th of May, Experian, Spirax, Compass, Burberry and Virtue on the 14th, 3i, Aviva, Grainger, Premier Foods, Watches of Switzerland on the 15th, and Land Securities and Future on Friday the 16th. But for all of those, 3 names may grab more headlines, not least because of the dividends they could offer, and how the dividend yields on their stock compared to the aforementioned Bank of England base rate. The 3 names are Imperial Brands with its first half results on Wednesday the 14th, National Grid with full year figures on the 15th, and United Utilities, which also offers full year figures on the 15th. Now, Imperial Brand shares trade at a 7-year high as Chief Executive Stefan Bomhard looks to build on the results of his first 5-year plan with a second one for 2026 to 2030, as outlined at March's analyst meeting. That new plan targets high single-digit percentage earnings per share growth on an annual basis and free cash flow of £2 to £3 billion a year, with the result that the FTSE 100 index member plans to increase its dividend and buy back shares each and every year in that 5-year period. Imperial Brands continues to overcome a gradual decline in cigarette volumes by means of higher prices, market share gains in its 5 target markets, and also cost efficiencies, as well as improved returns from its next generation products. These first half results for the year to September 2025, and thus the end of the first 5-year plan, will be scrutinised for the following. First, cigarette performance, particularly in America and Imperial's other target markets of the UK, Germany, Spain and Australia, looking at their volume and their market share. Secondly, sales growth in next generation products and progress in reducing the losses there. And also any comment on guidance for the full year, where Imperial's current guidance is for low single-digit percentage revenue growth, mid-single-digit percentage operating profit growth, and high single-digit percentage earnings per share growth, helped by the buybacks. Note that currency movements, notably dollar weakness, are a potential hindrance here. The net result of all of that is that analysts are expecting 5% earnings per share growth on an underlying basis to around 125 pence in the first half. Now, as for the dividend, Imperial has moved to 4 equal quarterly payments, and they're running at 40.08 pence apiece for this year, while a £1.25 billion share buyback continues. Add together those, and Imperial set to return £2.5 billion to its shareholders in the current fiscal year, or around 10% of its current stock market valuation. National Grid's shares trade at nearly a 5-year high, as they seem to be shrugging off any residual fears of what a Labour government might do to utilities, although having half of its assets in the United States does provide some kind of hedge here anyway. The electricity and energy network specialist is still having a busy time of it though, as it prepares for a new regulatory cycle here in the UK and in New Jersey and in Massachusetts. It continues to reshape its asset portfolio by means of disposals, and announces as of last week the arrival of a new chief executive officer later in the year. National Grid's capital expenditure is set to rise sharply here in the UK across the 2026 to 2031 regulatory cycle known as RIIO-T3, and last year's £7 billion rights issue will help to fund that spend, alongside the asset sales and organic cash flow. In this statement, analysts will look to both CapEx and cash flow for the year that ended in March, and also any steer on the new year just begun. For the year just ended, though, management's previously steered analysts to expect a 10% increase in operating profit, but flattish earnings per share thanks to the highest share count after the rights issue. Thereafter, the goal is earnings per share growth of 6 to 8% a year in the new regulatory cycle. National Grid rebased its dividend after that 2024 rights issue, and the first half payment of 15.84p a share represented 35% of the plan for the whole year to March 2025. Analysts currently expect a total payment of 46.4p a share, down from 58.52p a year ago, though that still equates to a 4.3% historic dividend yield. Finally, we come to United Utilities, the provider of water and wastewater services to the northwest of England, and it's preparing for its own new regulatory cycle, AMP8, as laid down by Ofwat. Now, an analyst meeting on the 19th of June may reveal more about that, but for this set of full year results, analysts will home in on performance against targets, where United Utilities expects to earn more than last year's £34 million in incentives, and capital expenditure, which is due to come in between £950 million and £1.1 billion, ahead of some big increases going forwards. And then finally, the dividend, where analysts are looking for 51.7 pence a share against 49.8 pence a year ago. The company is committed to increasing its payment in line with the CPIH measure of inflation going forward, and the expected payment equates to a historic yield of 4.6%. I hope that you and your families are all keeping well. Thank you for watching, and I look forward to seeing you again next time.